Good morning, this is Robert Kaars Sijpesteijn bringing you this morning's market update. US stocks took a fall yesterday with the energy sector removing previous gains from Monday, along with oil amid soft Chinese trade data which rekindled some fear that the global economy is weaker than anticipated. The US 500 dropped 8 points to close on 1,983.13. The US Tech 100 fell 33 points to close on 4,270.88. And Wall Street declined 82 points to close on 16,983. Looking to the commodities, gold declined $4.70 to $1,263.30, and Brent crude followed suit, dropping $1.30 to close on $39.54. In Europe, Mario Draghi is having no success convincing stock investors that the European Central Bank has the firepower to reignite growth. Several economists expect the central bank to cut interest rates when policymakers meet this Thursday, and 73% project them to boost the amount of money put into the financial system through bond purchases. Fund managers aren't optimistic about a post-decision equity rally. In the first year of quantitative easing, the Euro Stoxx 50 index fell 17% and volatility reached levels not seen since 2008. The gauge has dropped in each month, but one following an ECB meeting since April. Even after the central bank pumped about 720 billion euros into the region, manufacturing dropped to its lowest level since 2013. The inflation rate turned negative and consumer confidence worsened. That's led analysts to slash profit growth estimates amid the worst earnings letdown since at least 2007. Investors are pulling money out of European equities at the fastest pace since 2014. When the central bank started its bond buying program, shares were steaming towards a high and growing optimism about euro area's recovery. But a succession of crises, starting with Greece's near exit from the single currency, exacerbated by increasing unease over China's slowing growth, a Volkswagen AG emission scandal, and the Federal Reserve's December rate increase, battered sentiment, leaving stocks up only 3.9% for 2015 from as much as 22%. In contrast to a struggling EU, Europe's top 5 investment banks are now making less than half as much revenue as top 5 US operators, which beat their European rivals on almost every financial measure last year. It is the latest illustration of the growing global dominance of the US investment banks that now top even the league tables for investment banking fees in Europe, the Middle East, and Africa, the traditional stronghold of European banks. Analysts and executives agree that US banks were particularly favored by 2015's market conditions, as fee income soared in their recovering home market while Europe stagnated. The US authorities forced their banks to restructure faster in the wake of the 2007-2009 financial crisis. In Europe, Credit Suisse, Deutsche Bank, and Barclays are only now doing the heavy lifting on their restructuring. Still, senior European bankers insist they are starting to turn things round, even as they strip capital from their investment banks. As for the indices, the Germany 30 declined 87 points yesterday to close on 9,697.8, and the UK 100 dropped 54 points to close on 6,127.4. In today's corporate news, Spanish retail Inditex has reported net income of 2.88 billion euros for 2015. Deutsche Post left its final dividend for 2015 unchanged, and E.ON chief executive Johannes Thijssen has warned the course ahead will be tougher and longer than anticipated. Today's economic data in focus at 9:30 in the UK, industrial production for January is released alongside manufacturing production, and at 12 o'clock in the US, MBA mortgage applications are released. That's all for this morning's market update. Thank you and goodbye.